we've already started seeing a lot of blood on the ground because of defaults and not because the properties themselves are broken, but because the financing on those properties and obviously the original underwriting was just not sustainable. I think sometimes people misunderstand that communication has to only happen when you have good things to share. That's not the case. You have to share everything regardless. You got to stay in front of your investors and you got to stay in front of bad news, first and foremost, because if there's something that's bad and you're just trying not to communicate it, that's not the right approach. There's only one of me, good, bad, or ugly. There's only one John Azar, and my avatar is not going to do the talking for me. I do the talking for myself.
John Azar joins me here today, and you can learn what his team is up to. Head over to peak15cap.com. That's going to be a clickable link in the show notes. Really appreciate your time here today, John.
Of course. Thanks for having me.
Well, you've had an incredible journey in this real estate investing world. Can you start things off by briefly telling us your origin story? What got you interested in real estate?
Yeah. The origin story is one of those things where you kind of stumble upon an industry without a lot of preparedness beforehand. I had a couple of partners of mine before we opened my first company in real estate in Boston, working on a large debt deal. We were traders at Morgan Stanley and Royal Bank of Canada Capital Markets Group. We worked on this bond deal for large mixed-use development in Miami, in Key Biscayne at the time, that never ended up fully materializing for our firms at the time. But then after we stopped working on it, the folks that were in it kind of reached out to us, including the developer and the financiers and a couple of the other folks that were involved in that transaction, and told us that they would want to work with us if we ended up hanging our own shingles. So that's what we did. We hung up our own shingle and we started doing almost like investment banking, structured finance consulting for developers up and down the East Coast for large scale mixed use developments, either brownfield issues or waterfront contamination issues or urban conversion projects. And we did that until about 2009, until the recession and the crisis back then took the wind from underneath our sail. And we had to unfortunately close shop by 2010. So that's essentially how I got started. It's like I said, came across a project, we started working on it. And then that project led to us opening our first company called Boston Venture Partners at the time. And then, life moved on after that.
What made you get back on that horse then?
You just sometimes have to find a way around it and get back to it at some point. So a couple of years after that, I joined my brother in launching a syndication platform that he started working on before I joined him here in the Carolinas. That firm that we launched called Mac Venture Partners, and we transacted multifamily assets, only multifamily assets in the Southeast. So we concentrated on 5 states at the time: Carolinas, Tennessee, Georgia. Did a couple of deals in Texas and Florida, but did that for a better part of about 7 or 8 years until about 2020. We started sunsetting our portfolio in 2020, and that's when I launched my third company, which is Peak 15 Capital.
And now you're focused on commercial real estate.
Well, we have always been commercial real estate. It's just that we are a fund manager now. So we are in the private equity side. We partner with developers, operators, sponsors, and put out money from our own fund and join them, provide liquidity solutions for sponsors, developers, and operators. They come to us for partnerships on deal or to find the right financing or the right equity for the deal. So we provide either equity or GP economics, GP equity to the deal. So that's what our fund does for developers and operators.
So could you talk a little bit about your biggest challenges? What has been your biggest challenge now that you are more fund-based?
The biggest challenge always is making sure you have the right money in place. That's always a challenge with anybody who raises funds and deploys capital out there. You got to make sure that there's capital follow on to. You always got to make sure you have a fresh pool of capital ready to go. And, whether you're a fund manager or individual syndicator, money and capital is just not easy out there these days, especially now. This year has been particularly tough for money to be moving on the sidelines. We work a lot with institutional capital and institutional money. So it's been tough. The challenge of getting capital to move off the sidelines has been real this year for sure.
I was going to ask you, have you seen any kind of similar trends from 07, 08 to today, or is it just a completely different environment?
No, I mean, '07, '08, there was no liquidity. Back then, we had a bubble and there was no liquidity. Today, that's not the case. There's plenty of liquidity. So it's not really compared to '07 or '08 because back then we were liquidity constraint and today we're not liquidity constraint. However, the debt is still of a concern, both the sort of the national debt. Well, also the other difference is right now the debt concerns are more on sort of the consumer debt area as opposed to the mortgage debt, which was the case back in '08, '09. So although there's not a whole lot of worries on the mortgage debt side of the crisis, well, there is in the commercial real estate, not so much on the consumer end, but consumer debt is sky high. I mean, right now, consumer debt is probably the highest it's been. I haven't looked at the statistics, but it's a serious concern. These are some of the main differences between what's going on now and what's going on in '08. I don't think that we are going to see the same sort of market adjustments as we did in '08. I mean, '08, '09 was everybody was getting wiped out, whether you were in the mortgage business or you're a consumer or, you're a capital provider, or whatever. I mean, it was challenging for everybody back then. Today, if you have liquidity, it's less challenge for you. And a lot of people, there is a lot of liquidity out in the marketplace that's just sitting in the sidelines. And perhaps, that liquidity has kind of learned their lessons from the '08, '09 era, and they're being very cautious on where to kind of put out the capital, which is the right course of action to do. We've always been very conservative in our approach and our picking of projects to invest in and picking the right people behind the projects. That's probably more important than the project themselves.
So you mentioned that in the previous endeavor, you focused in on 5 states. What is the markets that you focus on now?
Peak 15, we are nationwide. So we're somewhat geographically agnostic. We don't really concentrate on any particular area. There's a couple of areas that we don't invest in just because of the regulatory environments, such as California. It'd be very tough for us to get a deal done in California, but otherwise we're geographically agnostic as far as our coverage is concerned. As long as the project makes sense and the underwriting makes sense to us, it passes our rigorous underwriting criteria, and the people behind the deal also pass our underwriting criteria, then we have a deal worth looking at.
So, raising this type of capital is a bit daunting for a lot of investors. Where did you even begin, and where would you advise somebody to begin if they were considering something like this?
Well, it depends what they're considering. I mean, if they're considering doing a fund or an individual syndication, if somebody's starting out into the business, I would highly advise them to start off doing individual syndication just so they can get their feet underneath them in terms of fundraising and capital and build their own investor base. You need that before you go toward the fund format. I mean, the fund format, you're asking people to essentially give you capital in a discretionary basis. So if you don't have a track record of executing on deals, or if you've not had a track record of delivering results or have deals that are in the marketplace that you're after, it's going to be really tough for you to go out and raise discretionary capital without identifying an actual deal itself. So yeah, that's what I would say is probably the biggest challenge for people. Starting out, I would say start out by individual deals and, do a syndication and then go from there and build up enough track record, build up enough sort of momentum and experience and track record so you can go out there and comfortably be able to raise on a fund format.
Well, based on your experience, then what type of asset classes or deal types are the most attractive or shows the most promise right now?
Well, we're seeing deals in a lot of great deals in developments right now, as opposed to ground up development, as opposed to stabilized assets. We're still seeing attractive deals in a couple of other asset types like industrial, flex industrials. We are the multifamily industry. I mean, it's definitely going through its machinations right now, but there are certainly some deals out there, especially if you can find distressed deals or deals that are being sold in conjunction with a lender because they were a default, part of the default portfolio or something like that. And there's going to be a lot of that because we've already started seeing a lot of blood on the ground because of defaults and not because the properties themselves are broken, but because the financing on those properties and obviously the original underwriting was just not sustainable. Unfortunately for those operators and sponsors who were not as responsible with their underwriting and overly aggressive with their assumptions and really overly aggressive with their debt and financing, didn't really know how to turn the ship around after a couple of years, then they're the ones who are unfortunately in trouble right now. So to answer your question simply, there are opportunities in various asset types. We're seeing more opportunities that make sense for us on ground up development right now than stabilized assets because of that disconnection in the capital markets. Developers that are entrenched in their deals and have the ability to kind of break ground, they're starving for cash and capital. They're willing to make the deal a little bit more amenable, and the cost bases are slightly lower. We got past through the COVID era adjustment on raw materials and all that kind of stuff. So that's somewhat back into somewhat normal levels to some extent. Pricing, however, didn't go back to pre-COVID levels. It always does. When pricing goes up, it very rarely comes down, regardless of economic circumstances in the world. But the availability is there. So from a material perspective, it's certainly feasible. Plus, it's more attractive to us from a development standpoint because the delta between development and stabilized assets is very, very small. If you were to be presented a deal that's 20 years old, as opposed to a brand new deal that's coming up in the ground up development, and there's only 20 or 30 basis point difference in cap rate pricing wise, I would go for the newer asset because you have less obsolescence and you're a lot more in control of that lease up period, and much more attractive product, obviously, than a product that's 20 or 30 or 40 years old right now in the marketplace.
Maybe I'm a bit skewed because with being able to talk to as many people as I do on this show, that flex space note in the real estate song is a pretty consistent thing right now.
Sure. Yeah. You talk about flex industrial?
Yeah. I'm hearing that a lot.
Those are very, very popular. Yeah. Those are good deals. If you can find, they're actually, even contrary to other asset types, they've actually gone up in pricing, and they're definitely being priced at a premium right now because, again, they're attractive for a couple of different reasons. Flex industrial, you can look at them and underwrite them similar to what you would underwrite multifamily because they're still multi-tenant approach to it, except it's even better because most of those are triple net lease, meaning you don't have a lot of capital outputs during the whole time as much. Yeah, you still have to take care of the common areas and the like, but overall, you're low maintenance cost coming out of pocket. Most of them are signing multiple year leases. The thing that's positive about flex industrial that has multiple tenants in it is that you're not dependent on one or two tenants to make it happen for you. If you have a flex industrial space with 10, 15, 20, 30 tenants, it becomes much more attractive because, if you lose one or two tenants, you can replace them and not have to worry about, you're out of money for a long time. Whereas if you have a large box industrial with one gigantic anchor tenant, if you lose that anchor tenant, those are very tough to replace. So that's why flex industrial is even more attractive than normal big box industrial.
Sure. Just remind everybody, we're talking to John Azar, and you can learn what his team is up to again at peak15cap.com. If you found some value in what we're talking about so far, this show only grows if you share it with an investor friend. So please consider doing that. If you're watching us on YouTube, feed that algorithm. A like and subscribe goes a long way. So with everything you've been doing, John, you would have probably have had some scaling pains along the way. What have you found to be one of the bigger challenges there, and what did you do to overcome it?
Yeah, for sure. Scaling is challenging in every stage, whether, the problem is recognizing how you have to scale and what you have to change internally to scale to go where you need to go.
Maybe I messed you up by changing the screen there on you.
Yeah, sorry about that. I didn't know if I lost you or was still there. Anyway,
should have given you a heads up.
Scaling is one of those things where it's a combination of art and science. A lot of time people don't recognize when and how they have to scale because they figured what got them from point A to point B is it's good enough to get us to point B. It must be good enough to get us to point C. And a lot of times that's not the case. So what got you from point A to point B is not the same thing that's going to get you from point B to point C. And a lot of times you have to change and adjust and change internally, not just change your approach, but change how you are structured internally, how your processes are structured, your infrastructure, even your roles and responsibilities among your team changes as you continue to grow and add more people or become more sophisticated or have a different approach to it. So I think that's sometimes the challenge with people is they don't really understand how to handle that, even recognize that that's necessary. For us, the scaling meant adjustment of people, adjustment of roles and responsibilities, adding different processes, adding different people to be dedicated on handling certain parts of the company. Operations becomes a lot more important, and you have to have a concentration on some of your workforce to handle that sort of operational acumen within the company. Same thing with investor relations, same thing with underwriting and originations. You have to be able to bifurcate the roles internally. It's not every person wears every hat anymore. Whereas when you're beginning, almost everybody wears, different hats. That changes as you continue to grow and add more people to the fold.
One of the things that I've definitely have heard frequently is that when you do this type of business, that communications to your investors are really a key element. Could you talk a little bit about what you've put into place to ensure that is being handled? And it's usually the situation where if there's a lot of silence, people's imaginations can run wild, and then we have some upset individuals.
That's true. I mean, communication is key, obviously, and whether it's good or bad, communication is key. I think sometimes people misunderstand that communication has to only happen when you have good things to share. That's not the case. You have to share everything, regardless. We have institutional investors, we have retail investors, and we try to stay in front of them as much as possible. We have a quarterly update newsletter with financials that go out to our investors, but our investors also, they know that we're reachable all the time. Anytime they have a question, they can go out and contact us. A lot of them have our personal cell phone numbers. We don't want to be one of those companies where we grow too big for people to be able to get in touch with, especially investors and financial partners. We want that accessibility to be always open and always transparent. And you create that by proactively being in front of people, either proactive reach outs on a monthly basis or newsletters or updates. We also do webinars twice a year, sometimes more if we have urgent things to communicate. We usually have a couple of webinars for our investors, quarterly newsletters, and individual reach outs on a monthly basis. So you got to stay in front of people. You got to stay in front of your investors, and you got to stay in front of bad news, first and foremost, because if there's something that's bad and you're just trying not to communicate it, that's not the right approach. The right approach is to always communicate it and just be upfront about it and just here's what happened. Here's what we did. Here's what we're doing to offset it or what we're doing about it. Communicate the bad news and then communicate what you're doing about it to either offset it or remediate it or to learn from it and do better next time.
So with the increasing availability of AI and automation, how's your team leveraging that? And have you found any productivity improvements or meeting some of these goals?
Yeah, this new world of more AI driven tools and more automation has definitely been helpful for younger companies like ours, where we are dealing with limited workforce, and it's also scalable. So if we use a lot of, obviously our tech stack has a lot of databases in it for various reasons, whether it's for CRM, market research, investor research, contact communications, or even tools like a simple note taker for our Zoom meetings or Teams meetings that we use. So that's been very helpful for us. And I'm sure it's a lot for other people as well, but it goes beyond that. It goes into accounting aspect and financial aspect. But at the end of the day, you still have to have people that are part of your team, whether it's your team directly or people that are helping you along the way, whether it's accountants or financial intermediaries or lawyers. You have to have the right legal partners and the right lawyers for you, the right accountants, the right fund managers. But it all starts with your team. You have to be aware of what you need for where you're going. And your team now may not be the same team that you'll have 2 years from now or 3 years from now or 5 years from now. But it's okay. That's just part of what growing is all about. You just have to be aware that at some point or another, you might have to make some changes and either add or subtract people.
Mhm. So did you find like some initial low-hanging fruit when it came to leveraging any of these tools that you saw?
Time is the best low-hanging fruit in those things. That's what you get with a lot of the technology tools these days. Is they're a huge time saver. They're not just time saver, time and money. Obviously, you don't need to hire an actual executive assistant who sits on the front desk and wait for somebody to come in. You can hire an executive assistant who's sits somewhere else, maybe even outside of the country, and be able to do logistical tasks that you're asking of. So yeah, I mean, there are plenty. I mean, I think the biggest hanging fruit is time. You find more. I think all these tools and mechanisms are aid for our time to give us more time to concentrate on doing the things that matter most, which are growing the business or growing the portfolio, finding deals or finding partners, talking to investors, reaching out to new partners and new investors. Those are things that you can offload to other people as well. But at one point or another, you're going to have to step up, and there's no replacement to the personal touch. Would hope nobody would ever get away from that, because at the end of the day, there's only one of me, good, bad, or ugly. There's only one John Azar, and my avatar is not going to do the talking for me. I do the talking for myself.
Yeah. No, I've been talking to a lot of people about this stuff, and I keep reinforcing the concept that all it can really do is free up the time so that we can actually focus on those conversations that need to occur. That
Sure.
in your world, I would imagine it's amazing how quickly we've adopted some of these tools. And I think we're almost starting to take some of it for granted. I would imagine using one of the deep thinking models, you can now research an area of the country that you might be looking to get into for the first time, and things that would have taken you weeks, if not months, to gather some of that information now can be returned to you within a few minutes.
Of course. Yeah. I mean, the time that it used to take you to whether do research or do underwriting or do whatever is certainly truncated a lot in the past few years. The same things that used to take you days now take you hours. The things that used to take you months now take you, or weeks, not take you days to get accomplished. So time is definitely the biggest low hanging fruit that you get out of this technological advancement and AI tools.
Going back to the real estate investing aspect of it, is there any big project on the horizon, anything you're trying to fund or research right now that's of interest?
We're always on the lookout for new partners. Luckily, we're blessed to be in a position where we know a lot of people in the industry. A lot of people know us because of what we used to do. I was in the sponsor shoes for many years. I spoke at a lot of conferences, and I still speak at a lot of conferences and get to meet a lot of people. It's always great to see folks that are potential partners with us come to us with deals. I think we're starting to see a little bit more deals come to fruition now from folks that we know and like and trust. We're trying to finish off this fund right now, and we're actually launching our new fund next year. So that's really going to be the next we're launching our next fund, which is going to have an LP and GP component to it. This fund is only a co-GP fund. So we have to come in with sponsors and partners and developers and partner with them on deals. We can't just be LPs only. Next fund will have an ability to have that sort of LP investment component to it as well, obviously with some caveats, and it's going to be much bigger in terms of capital available and dollar wise. So that's really the next big thing, is we're launching that next year, probably Q2 of next year is when we're looking at launching our next fund. And for now, we're just trying to make sure that we raise the last bit of capital we need to wrap up this fund, and hopefully, add a few more deals between now and the first quarter of next year.
Well, John, this has been a great conversation. Before we jump into the rapid fire and close out this episode, is there anything else we should have tried to hit on here today?
No, I don't. If people are interested in learning more about it's specifically about multifamily, the syndication, the process, the capitalization or capital raising, managing the deals, we're launching a course next month in probably end of September under the Peak 15 Institute flag. And that's going to be launched via boot camp. That's going to be available for folks to participate in. It's a 3-day boot camp. And after that 3-day boot camp, the course will be available to purchase, and people can access it on Kajabi to learn more. It's a full-fledged course. It's something we've been working on. My partner, Francisco, and I have been working on for, 3 years. So it's definitely a fruit of our labor, and it's got a lot of information. So if people are interested in more education and learning more about how to do this business, whether from a sponsor perspective or an originator perspective, and learn more about capital raising, that would be something I wanted to put a shameless plug on.
Well, would they find that information at the peak15cap.com?
They can, Peak 15, on our website, or they can also follow us on social media and Instagram, or contact me directly. We'll be able to give them information on that. There'll be an announcement on social media on that as well, and sell through my LinkedIn as well. And people can connect with me on LinkedIn or email me directly at azar@peak15cap.com. So.
Well, John, let's jump into the rapid fire and close out this episode. Just a reminder, peak15cap.com. I'm going to have that as a clickable link in the show notes. But if you're ready, we'll dive in.
Let's do it.
What lie do real estate investors often tell themselves?
What lie do they tell themselves that they can do it better than the last guy, or they will not fail like the last guy? And that may or may not be true, but that's not always the truth. So sometimes it's like you have to turn the mirror on yourself and think, the last guy failed. What are the reasons that they failed? And can I do it better, or can I do it differently? Or, and you have to be truthful with yourself if you can or not. I guess the other lie is what they tell themselves is what they're able to achieve in terms of their assumption. That's not necessarily a lie, but it's more of a falsity in terms of how you look at the market and the growth assumption when you underwrite a deal.
If you could go back in time and give your younger self a piece of advice, what would it be?
Start in commercial real estate earlier. Don't waste 10 or 15 years learning my way around finance, but directly go into finance in terms of commercial real estate and start on the industry 10, 15 years earlier than I did. But, that's what I would tell my younger self.
Do you have a book recommendation?
Gosh, I have a ton of books on my nightstand that I read all the time. It's like a rotating list of 6 or 7 books that are there. The latest book I'm reading right now is by Ray Dalio, one of the largest hedge fund managers in the world. The book is called How Countries Go Broke. It's about a study about how debt and equity and crisis of debt and changing works. So I love that book. I'm rereading another couple of other books that I've read before, but I'm just rereading them now. I'm rereading Atomic Habits, which is a great book. And I'm also rereading, The Devil Take the Hindmost. And that's also on my nightstand. It's about essentially history of speculations and financial crisis. It goes back to the history of even in the 1800s, early 1900s. So these are the 3 books I'm currently perusing.
And then finally, what single tool or process have you implemented that has had the biggest time-saving impact?
Trust other people. Trust your team and trust your other people, and don't be a control freak. Trust that the people surrounding you will do the job. Maybe not exactly how you do it, but hopefully if you have the right team around you, they'll get it done regardless of how they do it.
Well, John, this has just been fantastic. One last time, it is peak15cap.com. I'm going to be clickable link in the show notes, but it was really great to meet you, and I hope you'll consider coming back.
Of course, anytime.